Hello there and welcome to the recorded training on Japanese candlestick patterns. Okay, so you can see the first slide in the sequence there. Just before we get started, you'll notice that in the top left hand corner there's a little figure there that says S1. Now the reason we've done that is because we've got the Q&A sessions on the Sunday evening. We want you to be able to have a reference that you can obviously tell us of something that you've got a question about regarding that training session. So you can say, yes, I've got a question regarding Japanese candlestick patterns S1, the point being, and then ask the question. It will just give us an idea of what it is that you're looking at. Okay, so Japanese candlestick patterns. Now we're not going to go too much into the history of this. I have posted it on the Facebook community page. If you want to download the history, you're more than welcome to. But the references of candlesticks date back to between the 1500s and 1600s. It wasn't candlestick patterns have been successfully used in Japan for hundreds of years, but only recently, about 25 years ago, they came to the US trading community. So it's a good read if you want to download it from the Facebook, no problem. Okay, let's go to the next slide. Okay, what do candlestick patterns represent? Well, candlestick patterns basically represent points in a trend where there's indecision, where there's a possible bullish reversal, and where there's a possible bearish reversal. So it's giving us clues to when a trend might reverse. Now we're going to go through the meanings of the different meanings of candlesticks, but we're not actually going to go through each individual candlestick pattern because that's available for you on the professional course. So all you need to do is just go back and have a look, and you can see each meaning for the candlestick patterns that we use. The important thing to remember is that candlestick patterns aren't used randomly anywhere in a trend or consolidation pattern. They're pinpointed carefully to areas of support and resistance, which we will go through as well. Okay, so there's three different main types of candlestick patterns. There's the bullish reversal. There's the indecision, which means the market is indecisive about the direction, or the sentiment is indecisive about the direction. And then there's the bearish reversal. Rejection, buyers and sellers taking control. Okay, they're the three things that we're looking out for when it comes to candlestick patterns. Now you notice below I've got three diagrams. The one over on the left there is showing a trend decelerating. This means as these candles are getting smaller and smaller, it's showing that sellers in this case, because all the candles are red, are leaving the market. Now in the next candlestick pattern you can see those candles are getting bigger and bigger. This is showing that the trend is accelerating and more sellers are coming into the market. On that third diagram there you can see what we call a pin bar. Now this is the main candlestick pattern that you will see represented throughout the charts on a daily basis. It will also appear either this way up or the other way up in many of the candlestick patterns. So it's important that you can identify this one quite quickly. Let's move on to the next slide. When to look for candlestick patterns. Okay, now areas of confluence. We talk about areas of confluence when a price consolidates around a certain area, normally at a price that it's been consolidating at previously or at some point in the past. These are known as areas of confluence. Support and resistance, which consist of Fibonacci retracements, psychological numbers or whole numbers, trend lines and patterns. These are all areas that we should be looking for candlestick patterns. Again, if we refer back to the other slide there, it says we don't use them randomly. Okay, and we're going to have a quick look at the charts at this point. When we say we don't use them randomly, if a currency pair is trending, for instance, Let's take the pound for example. It's got a nice trend on it at the moment. If there's no area of support and resistance and a candlestick pattern develops, we don't suddenly look at it and go, right, okay, this is going to reverse or this is going to change, because if there's no areas of support and resistance, or it's not a Fibonacci level, or it's not a psychological number, then there's no reason to believe that it's going to actually make any difference at all to the current trend. So we're looking for those specific points in a trend where potentially a candlestick pattern would reverse, or a trend would reverse. Now we're already using those areas of confluence, those Fibonacci levels. We're using those in our trading every day. So all we're doing is we're looking for candlestick patterns to back up our already theory of a reversal point where we might be looking to get back in on the fundamental direction. It's like it's giving us an extra check. However, you can use them on their own when it comes down to sentiment, which we'll get into a little bit later in the slides. Okay, so again, let's go back to the slides. Which time frame should I use? Quite a big question. Now, time frames are a matter of preference. It depends on you as a trader to what sort of time frame you want to trade over. But one thing I will say is the bigger the time frame you use, the more reliable those candlestick patterns will be in your trading environment. However, with big time frames comes bigger trades, but with bigger trades comes bigger stop losses. So you need to be aware of this. I certainly wouldn't use a candlestick pattern less than a 30-minute chart, but I would recommend at this stage to use them on the 4-hour and the daily. And as we move through the charts, you'll see the reasons why. It's all about finding a comfort zone that suits you. How much of a patient trader you are. If you can sit for 1 or 2 days waiting for a candlestick pattern to play out, or if you'd like to see things develop within the hour. Okay. Now we're going to have a quick look at the charts again, just to reiterate on that point. Now at the moment you can see you've got the pound, US dollar. We're going to switch to the euro because there's quite a few examples on there throughout the course. It's easier if we use the one currency pair throughout. Okay, you can see on the 4-hour chart there. Now let's have a look, see if we can find a pin bar pattern. Okay, so here we've got a bit of a pin bar pattern, a bit of an indecision candle there. Actually, let's have a look, see if we can find something a little bit more consistent. Okay, so you can see here on the 20th of the 5th, 2015, there's a pin bar pattern. Now let's take that over to the daily. 20th of the 5th. Okay, you can see there that actual bar, there's not real much there to show as a trend reversal. Okay, and actually in actual fact you can see that trend does in fact continue down. So it's always best sometimes to check, what it is you're looking at, and then checking it on a different time frame. The 4-hour and the daily are a good representation. They give you a wide view of what's going on. So when it comes to time frames, let's just stick to those ones for now. Let's move on to the next slide for a second. Using candlesticks to limit risk, placing stop losses at previous lows, using candlesticks to work out risk reward, and taking the psychology out of trading. Now this is another reason why candlesticks are so beneficial. And again, let's have a quick look at the charts here. Now we're going to use the example on the euro US dollar. I like this example because it gives us all the scenarios. Now let's say here on the 4-hour chart we've got a pin bar pattern developing. Okay, so we know straight away that if we're going to enter this trade, whether it be on a new high or on a pullback, we're going to enter it and we're going to place our stop loss below this level. Why? Because that's where the pin bar has been rejected from. Now notice that it's not random, okay? It's in line with previous area of support, and also if we put a Fibonacci on this trend upwards, you'll also see that it's a rejection from the 61% level. Okay, it's come down here, it's rejected that 61%, and it started to push back up. In fact, see if I put that across there, you can see that a little bit better. Okay, so we know that we've come down to an area of a Fibonacci retracement level. It's been rejected. We can know that it's come down to a previous area of support. It's been rejected. So there's our first telltale sign that this is going to be a buy trade. Okay. Risk reward ratio. Now let's just get rid of all these drawings for a moment. How do we determine our risk reward ratio? Well, we determined our stop loss. So now we want to see if it's possible for us to be able to make a 3-to-1 on the trade. Now for those of you that haven't done the risk reward ratio and probabilities training, then please go and see that in the library. So if we were to enter this on a new high, for instance, on the green candle, let's go, we go next candle, it makes a new high, and we're going to enter that for a buy. We're going to look at our first points of support and resistance to see where we've got a potential of being able to climb to. Now you can see here that this area of resistance became support at this point, so this would probably be our very first target. If anything, it would be a partial take profit. We want to really aim for this target up here, or this where we've had previous highs. But we're looking at worst case scenario. Okay, so we've got our stop loss down there. We're looking at our first point of call. Now, when we take a partial take profit, we need it to be at least 1-to-1 or 1.5-to-1. 2-to-1 really is, that's where we've got to aim for. Now, as you can see, taking it on a new high is not going to give us that. Now, what happens if we use the 50% pullback method? That's going to increase our chances of reaching those targets quite significantly. At 50% pullback, even the earliest target gives a 2.5-to-1. So if we go to look at this and go, right, okay, this is our first target, a new high isn't going to produce what we want it to produce, we're better waiting to see if we can get a 50% pullback. Now this leads us into our next slide. When to enter a trade. Pullback scenario, new high scenario. Which is best? Be vigilant, be observant, but above all, don't be afraid. Now this is really important. We just go back to the probabilities situation and the risk reward situation and where our stop loss is. We know where our stop loss is. All we have to do is make sure that we can get that 3-to-1 overall, and as you can see, the target of this overall is 5.6-to-1 to that previous high, is 6.3-to-1. So on a 50% pullback, that is our acceptable entry price. If it makes a new high and never pulls back 50% and it continues up, then we haven't taken that trade, but we had good reason not to take that trade. Okay, so this is our situation. Now when I talk about pullbacks, let's look at that in a little bit more detail. Let's just remove this. Now you'll see that we've got this pin bar candle with the long shadow appeared. Okay, so we know that we've got a possible reversal before we see any of these next candles. It's the length of this candle that's important, because we want to try it on the next candle or the candle after. We want to be able to get 50% retracement on this up move to get into the trade. that's going to be our best case scenario. So we can quite easily just put a Fibonacci from one end of the candle to the other and see that our 50% entry price is at this price here. A much better price than trying to take it at the new high. Now, if I could take that at the new high and still get a 3-to-1 on my first profit target, then that's okay as well. But if we can't, then we must wait for that 50%. That's important because overall it's going to give you that longer profit in the longer term. Okay, but again, we can't be afraid. And also you've got the benefit of, if you get the 50% pullback, you've got the shorter stop loss as well. So again, lower risk. You're going to remove the psychology factor of trading with a bigger stop loss. If you've got a much tighter stop loss, you're more likely to take the trade if you've got a tighter stop loss than you are with a bigger stop loss. Even if the risk reward ratio is the same. If I've got a stop loss of 30 pips with a risk reward ratio of 3-to-1 with a 90 pip profit target, I'm more likely to take that trade than I am with a trade with 250 pips and a profit target of 750 pips. Even though they've got the same risk reward ratio, psychologically I'm more likely to take the trade that's got the smaller stop loss because I know that there's less monetary value to be lost. Okay, it's just basic human nature. Okay, let's have a look at the next slide. How to know when to exit. Now, knowing when to exit the trade is almost as good as knowing when to enter. Again, we're looking at support and resistance, and we're looking at candlestick pattern reversals as well. Now, before we go into the 90% of target reach, let's quickly go back to the charts again, and we're going to use that same trade. Now, we've had our 50% reversal. We've decided that that's our best place to enter. Now, we know that we've got previous resistance at this point here. Okay, this is probably going to be one of our initial profit targets because it doesn't make our 3-to-1, and potentially we wouldn't even lock in our entry level to our stop loss to our entry level at that point either. However, our bigger term is going to be at this sort of area of support and resistance. Now you can see as it comes up to that area of previous rejection, you can see where these candles here have started to get these long shadows being rejected from that area. We can see that that starts to happen already. Before we reach our target is the top of these candles. Now, if we start to get rejection and it turns around, we can safely say that by the time this candle opens and turns red and makes a new low, that it's time to exit the trade. So we'd exit at this place at the latest. Okay. However, now when we look at the 90% target reach scenario, if our target is here and we've travelled all this way, we're within 90% reach of our target. If we start to develop these candlestick rejections from that target, it's showing us that our target level is being rejected. We've already made 90% of our target. Is there any point in hanging on and waiting for these to give us confirmation of the reversal before we exit the trade and taking maybe only 60%? The answer is no. We should take once we get to 90%, if we've got signs of it not reaching that full 100% target, then we should take it at 90%. Even in this case, it does continue up. I would still have been happy of taking this on the rejection at 90% of the target. Okay, now the final question, which is probably the trickiest one of all. The final slide. Fundamentals versus sentiment. Now, I just want to go back to the charts for one more reason. Now, let's say in this case scenario, the euro fundamentally is stronger than the US dollar. Although there's no timeline on this trading, so that might not be the case at the moment. It's actually not the case right now, but It doesn't matter. We're using it as a figure. So the euro is stronger than the US dollar fundamentally. Now we know that we've had that Fibonacci from this point to this point, so we were looking to buy the euro against the US dollar all the time anyway, because that's our fundamental direction. It's had its pullback. We're looking for an excuse to get into it for a buy. We've had our rejection. We're at the 61% retracement on this current uptrend. We've bounced off a previous support level. We're in line with the fundamentals. There's nothing to hold us back. Okay? Why? Because overall we know the direction of the currency pair anyway. So in line with fundamentals is going to give us the green light. Okay? It's a go trade. There shouldn't really be much hesitation there. Now what happens if we continue up here and we get this rejection at this level? We get a pin bar rejection at this level. Again, we get a little bit of indecision, but then we get rejection. Let's just say these candlesticks are formed a bit more of a case for a sell trade. Now, of course, trades do reverse. They pull back. Nothing goes straight up, nothing goes straight down. We're always going to get 50% reversals, or 61% reversals. Can we trade those reversals? Of course we can. We're trading the sentiment. Okay, we'll be trading the sentiment of the market. We're looking at those candlestick patterns and we're seeing that sellers are coming into the market at this point. We found an area of resistance. Why wouldn't it be a sell? Okay, and by the laws of going what we've just talked about, if we in fact put a stop loss at this price and aimed for a previous area of confluence, support and resistance, which would be this area, we would in fact make a profit. But we are trading against the fundamentals. Now this is where it comes down to a matter of risk appetite. You might be a trader that likes to have everything in their favour. Okay, you might to see the fundamentals lined up properly. You might like to see candlesticks on the 4-hour chart, then confirm them on the daily chart before you take the trade. You're probably going to trade much less, but you probably might have a higher success rate. What if you're not as patient as that? You like to take the candlestick patterns when they appear at support and resistance areas. Being aware of the fundamental direction, you'd still take a trade against the fundamentals, knowing that the sentiment is in play. That's fine. There's nothing wrong with doing that, but that's what I would call an amber light trade. Okay? Just being aware that there is that extra little bit of risk is important, because it's going to help you make the decision on whether you should hold that trade or get out of that trade when candlestick patterns start to develop in the opposite way. So let's go back to the charts again just to reiterate what I've said there. So let's just say, for instance, we're going to use this pin bar to get in for a sell. We're going against the fundamentals. We come down to our support and resistance level. We get a green candle. We've got a double bottom or a tweezer bottom rejection here. Do I need to wait for it to pull all the way up here before I decide to get out of the trade? Bearing in mind we've gone against the fundamentals, probably not. The answer is I'm going to get out of that trade as soon as I hit the support resistance, because it's a sentiment trade. There's less chance of it continuing down than there is of it going up, because that's the fundamental direction. Now the last one I want to talk about is indecision against fundamentals. Now these are red light trades. Okay, now what do I mean by this? Well, let's just say we're going back to the original scenario. The euro is stronger than the US dollar. We've had a period here of indecision. You can see we've got long wicks either side with small bodies. Now again, check the professional course, look at the candlestick patterns within that, and you'll see what candles are indecision candles and what candles are bullish or bearish. So we've got indecision. This is slightly green, okay, which is fine. It's actually an engulfing candle pattern there, suggesting a buy, and there was profit to be had on that pair at that point with the fundamentals again. But then we get indecision in the market, more indecision. it breaks down. Okay, here we get rejection from this level and an engulfing candle. Would I take the sell at this point? I wouldn't, because it's a candlestick pattern against the fundamentals that's directly after indecision. Okay, so that would tell me this is a red light trade. If this was the other way round, we had a red candle and a green engulfing candle, and it was after indecision, I would take that for a buy. That would be an amber trade. It's after indecision, but it's going with the fundamentals. Okay, because it's broken down, it's going against the fundamentals, and it's happening after indecision. I would class that as a red light trade, and I would probably avoid it. Okay, so let's just quickly recap. We know that candlestick patterns appear throughout the charts, throughout the days, in random fashion. We know that when we want to look for candlestick patterns, we want to look for them at our Fibonacci levels, our support and resistance levels, our areas of confluence. We want to enter the trade in the best case scenario, which is going to be on the pullbacks. Okay. Let's go back just to recap here. We know that there's three different types of candlestick patterns: the bullish reversal, the indecision, and the bearish reversal. We know that they represent rejection from areas of support and resistance, where buyers or sellers are coming into the market at those points. We know what we've just covered, to look for candlesticks at those areas. We know that the time frames are, the bigger the time frame, the more reliable the candlestick pattern. At this stage of your trading, I would recommend sticking to the 4-hour and the daily. Using candlestick patterns to limit risk, we know that we can take the psychology out of trading by using those areas of candlestick patterns to place our stop losses and to be able to work out our risk reward ratio with quite easy philosophy. We know that pullbacks is the best scenario, although as long as we can get risk reward ratio, a new high is still available to us. But we also have to be vigilant and observant to support and resistance areas that are around us. But above all, don't be afraid to take the trade. We know when to exit when we get a candlestick reversal in the opposite direction on a good long trend, or at a support and resistance area, which is generally where we take profit anyway. Or if we only reach 90% of our target, and then we start to get a candlestick pattern demonstrating a reversal on our trade, we would then take profit. We now know what our green light, our amber light, and our red light trades are. Trading in line with the fundamentals is for a safer trade. Trading against sentiment can also be very rewarding, but has a higher risk value. Indecision and then trading against the fundamentals is dangerous. It's a red light. Okay, so hopefully you've managed to make some questions. And again, the Q&A will be live every Sunday evening, and you can bring those questions along and fire them at us, and we'll do the best to answer them. I hope candlesticks have now become a little bit more easy to understand as they were from the professional course. This recording will be in the library for you to reference whenever you like. The library for the different courses is at the bottom of that course. So for the professional course, everything related to the professional course will be listed at the end of that course. Okay, thanks for watching, and I hope to speak to you soon.